Hi friends, we have discussed something about assumptions underlying capital budgeting, followed with maxims in capital budgeting. Now stage has come where we are going to evaluate the projects. We should have tools to evaluate. Say if you go to a doctor will check up with the temperature only with the help of a tool. He will just check up whether the person is having normal breathe. Another tool is there. What is a tool that we have to evaluate a project? Not one, there are many we have. So tools for capital budgeting are to be divided into two parts. One is DCF method, the other one being non-DCF methods. You can call this as capital budgeting appraisal methods, or you can call that as tools for capital budgeting. So how do I evaluate if a person is having temperature or not? So definitely you require that tool. So for heartbeat, another one. I may not be knowing about the names of that, but when it comes for a project manager, I should definitely be saying yes or no based on some tools. What are those? We may classify them into two as DCF and non-DCF. What do you mean by DCF? Discounted cash flow methods or tools. Non-DCF, you know that we will not discount the cash flows at all. Time value of money will be ignored. So there are two tools that you have under non-DCF. They are number one, payback, and then number two, ARR, average rate of return or accounting rate of return. The first one under discounted cash flow method would be NPV and followed with IRR. Then we have profitability index or benefit cost ratio, then followed with equated annual cost or equated annual benefit, and lastly it is discounted payback method. So how many tools that you have? 7 tools that we have. 2 falling under non-DCF, 5 falling under DCF. Now let us just take up as how these items are to be conveyed. If you take up liquids, the weights will be expressed in gallons, liters, kiloliters and so on. If you have solid stuff, you just find them, people just express that in terms of kilograms, quintals, etc. Likewise, how these items will be evaluated, we should know how it is to be conveyed. If it were to be in India, we call that as after a lakh, 10 lakhs, crore and all that. If you just find that in CPA and other studies, they go for million, billion, trillion and so on. So the expression changes, and now let us just get acclimatized with these expressions. Number one, the expression for payback will be in terms of years. What do you mean by that? How quick you can recover your capital investment through cash inflows. How faster you can do, what is the shortest period of recovery is what we look at in the case of payback. ARR, any RR for that matter. What do you mean by RR? Not the cinema RR. So rate of return, accounting rate of return, average rate of return, whatever may be the term that you use. Rate of return would mean always it will be expressed in terms of percentage. Then next item, NPV. Whenever you express value, it should be expressed in rupee, dollar and pound, shilling, euro, etc. Then comes IRR. Once again RR is coming. So it should be expressed in percentage terms. Then you have profitability index or benefit cost ratio. Whenever you say as an index, which will be expressed in terms of points. So how many points had gone up and come down? Whenever you just find, click the news channel, they say that BSE went up and NSE came down. This sort of point statement only they tell. Then how this equated annual cost and equated annual benefits will be taken up. That will also be expressed in terms of rupee value, dollar value, etc. Because you say equated annual cost, equated annual benefit. Cost and the benefits are to be expressed in terms of rupee value. And then lastly, discounted payback, and that you express that in terms of years. As how you had payback the first one, the 7th one is also payback, but prefix that you have, that being discounted payback. So therefore the expression will be in terms of years only. Next one, benchmarking. What do you mean by benchmarking? So in the schools and all that, we used to do desk marking. That is not the one that we are looking at as benchmarking. Accept, reject criterion is what we call it out as benchmarking. That is, if I have this, I will accept. If I don't have this, I will not accept. In the school times and all that, 35 is the benchmark. If a student had secured 35 and above, he is pass. And in CA, 40 and plus on individual subjects, pass. Overall 50. If you take up CPA, it is 75 percentile. If you take up CMA, it is 72 percentile. So that accept reject criterion for which we require a particular yardstick, and that is what we call it out as benchmarking. So in the case of payback, the shortest payback only you have. What is shortest will be different from project to project, but generally you can say it is shortest payback is required. And whenever you have RR, it should always be on the higher side, so highest. And when it comes for value, it should be greatest. And as you know, IRR and ARR will have the same form of expression in terms of highest percentage. Points also greatest. In terms of cost, lowest, that is equated annual cost would mean lowest, equated annual benefit would mean the highest. Then the last one, discounted payback, where you have that on a shortest basis only. See, now let us just know what is EAC stands for. EAC stands for equated annual cost. EAB stands for equated annual benefit. So we will discuss that individual tools separately. Now it is a bird's eye view that we have got on tools used in capital budgeting. So I hope that all of you can easily understand that the 7 tools are divided into 2 parts as non-DCF2, DCF5, and how they are benchmarked and how they are expressed, all that we have just seen, and individually we are going to discuss all this in next lectures. Thank you.